Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, December 28th, 2024. Hey, how you doing? Thanks for coming to my weekend review podcast. I hope you're doing well. Hope that you had a good Christmas and a nice holiday, and hope you are enjoying your weekend. Interesting week last week in the market. We did have a bit of a down move, and then we had a correction back up, and then a move back down on Friday. But in this podcast, we'll try to go over and see what the market's doing, look at the structures, and hopefully that's going to be helpful for you. So the regular format for this podcast is, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, both the open positions, the closed positions. We're going to talk about when I entered the trade, why I entered the trade, what was the setup, what were the confluence of signals that made me decide to get into the position. And then I'm going to talk about how I position size. I'm going to talk about where I place my emergency stops, my end of day stops. I'm going to talk about how I take partial profits if the market starts moving my way. We're going to talk about significant overhead resistance levels where I may completely exit the position. So hopefully that's going to be helpful for you. I do trade 7 different strategies, and so in today's positions there's a mix of them, and so hopefully, like I said, that will be helpful for you to see how I look at different markets, different setups, and the different strategies that I use. After that, we're going to talk a little bit about trader psychology. It is always the most important skill in trading, is the ability to create a plan and follow it. The most important thing, and that skill comes from between your 2 ears. It comes from the discipline that you have of following your plans. It's so important, and then we'll talk about that in the podcast. And then last night I did go through my entire master watch list, both on the daily time frame and the weekly time frame, and I have identified some potential entries next week that look good to me. They're not where they need to be yet. That's really the key in my trading on the weekends, is going through, looking at all the charts and saying, okay, this one, boy, if this stock here got to this level, then there would be a 200-day moving average. There may be a double bottom bullish MACD divergence that's in a low 30 RSI area. So I try to look for as many confluences as possible, but the key is just being patient and waiting for those markets to get to that ideal area. They may not get there, and if they don't, then that's fine. They'll just move on to another market. But I promise you, some of them will get to those really key sweet spots, and then at that point, you have to decide, okay, they're where I want them to be. Do I want to take the trade? So I have identified, I think, 11 on the daily, and I can't remember how many on the weekly, but we'll go through that as well. But that really will improve your trading, in my opinion, a lot if you just identify things on the weekend for the next week, and then if they get there, doesn't mean you're going to have a profitable trade, but I promise you, you'll have more profitable trades than not if you identify an area, wait for it to get there, and if it gets there, then you can decide to take the trade. So I hope today's podcast is going to be helpful. If you have any comments or questions as you're watching, go ahead, just type them in the message section, and I will do my very best to get back to you. So let's run the U.S. legal disclaimer, get that out of the way, and then we'll get started. Thanks so much.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started with Intel. So Intel, I got long Intel back on the 10th of December, and let me zoom out here. And please notice this green box here. This green box is what's called an bullish order block, and it stems all the way back here from the 7th of August. And a bullish order block is when you have it's the lowest down bar close before market structure change. And market structure change just means we took out a swing high as we did here. So now this green box going out into time here will tend to be a bounceable area. So I took this trade here on the 9/11 because we rejected the bottom of the order block, and we also had a V2, and I had this nice big move up here. But again, it starts with the order block here on the 7th of August. It's the lowest down bar close before market structure change. When market structure changes to the upside, when it pulls back into this order block, it tends to bounce, just like it did on this trade. Well, so let's fast forward now to the current trade on 12/10, where I entered at $20.16. Why? Well, I entered here because it came back into the bullish order block, and I like to wait for confluences, combinations of signals. And on this particular day, not only did we go into the order block, but we went under 30 over 30, which if you've been watching this channel, you know that's a deep dip buy signal. So that's the confluence that we're working with here. We've come into the bullish order block, and we went under 30 over 30. So I did enter the trade at $20.16. So the first thing when you enter a trade, it's very important that you position size correctly. And there's two inputs for that. One is the account value, the current account value that you have, and also the 2 ATR. I use both of those, and I'll show you how I do it now. So let's just say you have a hypothetical $100,000 trading account. I take 1% of that. 1% of 100,000 is $1,000. If you were dealing with a $50,000 trading account, then you just substitute 1% for 500. If you're dealing $1 million trading account, 1% is 10,000. So for the hypothetical 100,000, 1% is 1,000. I take that 1,000, I divide it by the value of the 2 ATR. The value of the 2 ATR is $1.68. So I take $1,000 divided by $1.68 is 595 shares. So based upon my account value and the 2 ATR, which measures volatility, the correct, for me anyway, 595 is the correct amount of shares to buy for this trade. So I go in here, I buy $20.16. Now the first thing I do is I take that value of the 2 ATR, $1.68, and I take my entry price minus $1.68. This is my emergency stop down here at $18.37. Now, if I have 595 shares and it moves down $1.68, then I have lost 1% of my total trading count. But the good news is that only happens about 5% of the time. The other 95% of the time, if I have a loss, it won't be an emergency stop, it will be my end of bar stop. And for this particular trade, because it's a combination of a deep dip buy with the under 30 over 30 and the bullish order block, my end of bar stop would simply be a close under the 30 RSI, because I really took the trade because it went under the 30 RSI intraday and then closed back above. And so then if it closes under the 30 RSI, that will be my end of bar stop. And of course, always the emergency stop down here if it just goes down there. Now, I wait till the end of the day to make my decision unless it hits my emergency stop. So got here at $20.16. So the getting into the bullish order block, the under 30 over 30 was the signal. I positioned size correctly. I placed my end of bar stop 2 ATRs below. I placed my my emergency stop 2 ATRs below. My end of bar stop simply under 30 over, like we just mentioned. And then the next thing I do is, here is the orange line. This is my this is my trailing stop. This is 1.5 ATRs above my entry. You can see here's my 1.5 right here. And so what happens here is when I take the trade, if it ever gets to 1.5 ATRs, then I go into what is called trailing stop mode. Didn't do that. Now, everything I've talked about so far, as far as being patient, waiting for your entry, position sizing correctly, placing your end of bar stop, placing your emergency stop, placing your end of bar stop, placing my 1.5 ATR trailing stop level, these are all defensive moves. These are all created to rules that are created so that if something goes against me, I take action. So that's defensive. But I also like to play offense in my trading. And by playing offense, what I mean is I like to take off a portion of my position if the market moves my way. And the way that I do that here, and I'll show you this for Monday, I just take the closing price right now, which is $20.32. So this changes every day because the closing price is different every day. $20.32. Now I look over here to my 0.45 ATR, which is 38 cents. So I take the closing price plus the value of the 0.45, which is 38 cents right now. This changes every day as well, plus 0.38. My first profit target for Monday is $20.70. So that's 20.32 plus the 0.38. My first profit target for Monday is $20.70. Now I take my first profit target again. I'm going to do this 3 times. 20.7 plus 0.38. My second profit target for Monday is going to be 21.08. Then I take the second profit, 21.08, add it again, plus 0.38. My third profit target, 21.46. So I always have 3 profit targets for the next day, and I put those in as limit orders, and the amount of shares that I take off is 10% of however many shares I went into the day with. So I go into the day with 100 shares, I'm going to have 3 profit targets of 10, 10, and 10 at those 3 different profit targets. And so I do this every single day. And the reason that I do this is I want to take off a portion of the position if the market gives me something. Okay? And this is one of my favorite methodologies in trading, is playing offense and defense, right? I want to be patient. I want to wait for a setup. I want to position size correctly. I want to have that emergency stop in place just in case everything goes against me. I know how much maximum I'm going to lose. I'm going to have my end of bar stop, trailing stop level. So if it gets to my trailing stop level, then I go into trailing stop mode. These are all defensive, but I also want to take a little something off if the market gives me something. So, okay, so setup again. We got into the bullish order block. We had an under 30, over 30 deep dip buy. Entered in at $20.16. Emergency stop 2 ATRs below. End of bar stop closed below 30 RSI. Place my 1.5 ATR trailing stop level above. Okay, so the next day, nothing happened. Next day, it moved up. It moved up enough for me to take off 1 profit target. So I reduced the position, locked that money in the bank. Next day, we were down a little bit. Next day here on the 16th, up again nicely, which was good. I hit another profit target. Then we had an inside day. Then we had this big down day on the 18th where the market just got rocked. Now, I didn't get out here because it still closed over the 30 RSI. So that kept me in the trade. Next day down again. Next day opened up. Look at that. Opened to the penny under the right at the bullish order block. And I'm telling you, these order blocks are strong. And so it opened up right there, bounced, and immediately has gone up from there. So that particular day moved up enough to hit 1 profit target. Keep in mind, this profit target, I took it off. It was underwater on the trade. It was not a profitable profit target. But still, the market doesn't care if I'm profitable or not. I'm just going to take a portion off if the market gives me something. And then on the 23rd, up again, hit another profit target. And for the last 3 days, hasn't done much, has kind of gone sideways. So I'm grateful to be slightly positive in this trade. I mean, not much, but something. Let's take a look here. This is, yeah, about 0.64% positive on the trade, but that seems like 600% compared to where this trade was. But it's really interesting to me that Intel, to the penny, got to the bottom of the order block, really showing that the market does kind of remember these order block areas. So I never got to trailing stop mode, so I'm not going into trailing stop mode yet. All that means is if I get to trailing stop mode, then I have a close below a previous bar's low, then I will get out of half of the position. So I don't have a lot of positions this week that have done a lot. I exited a lot of positions in the last 2 weeks. If you've been watching, you'll see, and you saw how important that taking those profits were when I took them because of the down move that we have. So anyway, Intel so far, the remaining shares up 0.64%. But really glad that it finally got positive after this huge move down from last week. Okay, let's go next to Coca-Cola. So I did get long on Coca-Cola here on the 23rd of December. Why? Well, this is a deep dip buy based off of the 300-day moving average. You can see here is the orange line is the 300-day moving average. So on this day, the reason that I took this trade was during the day we went below the 300-day moving average and we closed over the 300-day moving average. So there were no more sellers down here at the 300. You can see last time back on the 15th of November, when we got down to the 300-day moving average, that's where the buyers came in and we had a nice little rally off of the 300. Well, it did the same thing here. It got all the way down to the 300 during the day. There were no more sellers down there. That's why we rallied. And so I got long here at 62.36. So I positioned size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close under the 300-day moving average. I placed my 1.5 ATR trailing stop level above. And now I know exactly what I'm going to do. I position size correctly. If it hits my emergency stop, I'm going to get out. Luckily, there's a small chance of that, only 5%. And then if we close under the 300, if there's enough sellers that on a closing basis that they can't get it to rally above the 300, then that's a bad sign. I'm simply going to get out. So the next day, you can see we rallied up nicely. I hit one profit target. And then the last couple days just haven't been much, and this is up very, very slightly, about 0.16% on the trade. So we haven't reached trailing stop level. We have not closed below my end of our stop. We have not got to emergency stop. So we're just kind of hanging out here and consolidating, and we'll see what happens. But the point is you need to have a plan regardless of whether it goes up or it goes down. So I know not much of a trade here so far, but hopefully we'll move up or we'll move down, one of the two. So that's Coca-Cola. And then Verizon. I did get long Verizon here on the 26th of December. I talked about it last week. I said if we go under 30, over 30, I would get into the trade, and that's exactly what it did on the 26th. In addition to going under 30, over 30, we also formed a V2. V2 consists of 3 bars, bar 1, bar 2, bar 3. Bar 2 goes under bar 1's low, bar 3 closes above bar 1's close. So that was the confluence of the trade. Under 30, over 30, and a V2. If you'd like to learn more about V1s or V2s, you can go to my YouTube channel. I have a free video there about V1s and V2s. So I got long here at $39.96. Placed my emergency stop 2 ATRs below. And my end of bar stop is simply a close below the 30 RSI. Right now, the RSI is 30.65. So, Monday, if it closes at 29.99, I'm out. But that's okay because it would be a very small loss. And that's the key with trading, everyone, is getting a good risk to reward ratio so that if you're right, you can be right big. And if you're wrong, you just simply have maybe a little small loss. Never fun to have a loss, but you just get out, take the loss, move on, and then it closes back above 30. You can try again. This line up here is my 1.5 ATR trailing stop level. So this trade is basically even. It is down 0.15 percent. So we'll see what happens. But the key is I have all these rules in place now. If it moves up, I'm going to take partial profits. If it gets to my trailing stop level, then I'm going to go into trailing stop mode. If it goes crashing down and goes to my emergency stop, I simply get out. I know how much I'm going to lose. And then if it just goes down and closes at 29.50 or 29.99 or 28.65, whatever, anything under 30 RSI, I'm simply going to get out of the trade. So these three open positions here haven't done a lot. Like I said, I did get rid of a lot of positions last week, which I'm glad I did. But so these are just kind of starting positions. Intel up 0.64%, Coca-Cola up 0.16%, and Verizon down 1.5%. Okay, let's go to the trade that I closed out. This was a big trade. This was Sprouts Fresh Market, and I did get short here. Sprouts Fresh Market on the 12th of December, 12/12. So why did I get short here? Well, this is another. We talked about order blocks, bullish order blocks. Well, this is a bearish order block. And, I have been using these, I teach these, but order blocks are strong. I can take you back through many trades of order blocks, long and short, that I've had and show you really good trades. Well, I got short here. Well, let's first talk about where the order block is. The order block is this blue area. This bar here on the 4th of December is your highest up bar close before market structure changed to the downside. And I was talking about bullish order blocks. Well, bearish order blocks they look very strong, but then you break structure to the downside. And if you're in a bearish market structure, you want to short that first rally. And that's exactly what I did. So on the 12th, we broke structure here when we took out this swing low. Then we came back up, rejected the bottom of that order block, and that is why I got short at 149 even. I position sized correctly. As I showed you at the beginning of the podcast, I placed my 2 ATR stop above, and my end of bar stop is simply a close above this order block here at 154.16. Place my trailing stop level 1.5 ATRs below, and then as always, because this is short, if we go down the value of 0.45, I'm going to take partial profits. And so that's what I did through this entire trade. So again, rejection of the order block got me short 149. Next day we moved down, not enough to take any profits. Next day we moved down substantially. I hit two profit targets, intraday profit targets. Got out of those, took 20% off. In addition to that, we got to trailing stop level. So now I'm in trailing stop mode. And all that means is that if now I have a close above a previous bar's high, I'm going to get a half. Then next bar, next day, down again, more profit targets. Next day, down again, more profit targets. I'm in trailing stop mode, but we haven't closed above the previous bar's high. Then we had an inside bar, and then here on the 20th, we went down again, more profit targets. At this point, we are at a 35 RSI level, and all that means is now if I have a close over a 5 EMA, I'm going to get out of the entire trade. Here on the 23rd, we went down again. So the short was really just amazing, but on this particular day, we went under 30 and over 30. So that I took half of the position off, just the rules that I have. If I was long and I went over 70 and under 70, I take off half. So it's the opposite for the short. We go under 30, over 30, I take off half. So I took off half here for a gain of about 15.19%. Now, I don't take it all off. I took half off because we went under 30, over 30. This is the area where some buyers would come in. So if I'm short, that would probably be a good place for me to take my profits and get out of some. But if I go under 30, over 30, I take half. But to get out of the rest of the trade, I then in the future need to close above a previous bar's high, which happened the very next day. It finally closed above the previous bar's high. And so I took the other half off for a gain of 13.25%. But really big trade, and I didn't have to do anything other than just follow my rules. We get to the order block, rejected it, got short, 149, emergency stop, 2 ATRs below, end of our stop, a close above the high of the order block, trailing stop level here, and then take the profits along the way. But that was a big trade, everyone. Yep, that was a big trade, nice trade, and glad to be out of that. But that really does show the power of the order blocks. So those are all the trades. Didn't have a lot of them. I cleaned up a lot. So just real quick recap. Intel still open, long, up 0.64%. Coca-Cola still long, up 0.16%. Verizon long, down 0.15%. And then the Sprout Fresh Market closed out half at 15.19% gain and the other half at 13.25%. But that's really the key. It's okay to have big gains in trading. Obviously, that's what we want. But it's also okay to have small gains, which on Intel and Coke, small gains. It's also okay to have small losses. Verizon down at the moment, down 0.16%. What 1.5%. But it's in what we really, our goal is trying to stay away from big losses. If you have big losses all the time, you're never going to be able to make money. If you have small wins, medium wins, large wins, and small losses, that's how you make money. So, all right, let's talk a little bit about trader psychology before we start looking at our new trades, possible trades for next week. Okie doke. Somebody sent this to me and I wanted to share it with you. And for those of you who've been trading for a while, I think you'll get a laugh out of it just like I did. Okay, here we have, I forgot the actor's name. He's a good actor, but here are new traders and here are experienced traders. New traders, shiny face, full of energy, motivated, pumped, ready to go. Experienced traders, they've had their nose bloodied a little bit. They've been through the wars. But everyone, this is so true. This is why this has been making the rounds on the internet, because new traders have not gone through what trading can take you through. Trading is tough, everyone. I guess what I'm trying to say here in the trader psychology section is, we're coming up on a new year, and some of you have had a great year trading. Some of you have not had great years trading, but there is an easier way to trade, everyone, and it is creating a plan and following that plan. If you start thinking you're smarter than the market, if you start finding yourself saying words like, well, that can't do that, or this has to do that, that's not a good sign. We don't ever know what's going to happen. All we can do is put our trading plan together and then follow it. Don't get in and monkey with it and mess with it and go, I think today that's high enough. I don't think it's going. And then it goes up for the next week and you're not in it. Process-driven trading is just a must. And, if you take any trading approach, whether it's something you learn on the internet or something, you learn from me on the internet or someone else, there are a lot of good trading methodologies out there. Really, there are a lot of, and they don't have to be complicated. They can be very, very simple. But the weakest, the weak link in any trading approach is not the rules. The weak link in any trading approach, trading strategy is you. You are the weak link. You, the trader, is the weak link and the vulnerable link. It's not, oh, I should have used the 21 EMA instead of the 20 EMA. Pfft, no, has nothing to do with it. Really, it has nothing to do with it. It's whether or not you follow the rules. Whatever it takes, everyone. There's a lot of solutions to this. Have your husband, have your wife, have your boyfriend, girlfriend, friend. Look at your trades to make sure you are following your rules. The key is to create it and then follow it as you created it. But people get in and monkey around with it. But I want you to be this dude, right? Fresh, just relaxed. That's the new trader. Well, the new trader, if he doesn't follow his rules, he's going to look like this dude. Same guy, but he's going to look like this dude. Why not be this one here and over here, right? It's possible. It's a more holistic way to trade. It's a better way to trade. It's a smarter way to trade of getting yourself a good trading approach and then just following it. And I can teach you. I can teach you all 7 of the different trading approaches that I use. They're all good. They're all great. They all make money in the long run. And I'm happy to teach you. I teach a one-on-one course I taught people from all over the world. It's a 15-hour course, 3-hour sessions, 5 sessions. There's your 15 hours. And I teach you step-by-step how to trade every single strategy. I teach you all the rules. We do all sorts of simulations so that, I teach you the strategy, and then we look at random charts, random time frames, and then you tell me, okay, Greg, I'm getting in here because of this, I'm getting out of here because of that. And I'll say either yes, that's correct, or no, and I'll explain why. But I don't let you go as a student until you can prove to me that you know every single strategy and every single rule like the back of your hand. And it's a great skill. You'll have a great skill that you can use the rest of your life to make money. But if you take the course and then you don't follow it, then what good is it, right? So new traders, experienced traders. If you want to look like this dude here and over here, just follow the rules. Win, lose, or draw. You're not going to win on every trade. You're going to have losing trades. Even with the best trading strategy, you're going to have losing days. You're going to have losing weeks. You're going to have losing months. I have losing months too. Not very often, but I do. But then you're going to have really good months as well. So anyway, I wanted to share this with you, but and really what I want to put forth here for coming next year, make yourself a New Year's resolution in your trading. If you're having challenges, I am going to get a plan. I am going to follow that plan. I'm not going to monkey with it. And I promise you, you're going to make more money and have less stress so you don't look like this cat over here. Okay, let's get to the potential trades for next week. And let's start off on the daily trades with AGQ. Okay, AGQ is double leveraged silver. And what I want to point out to you here is this bar here is in the green. This is what's called a bullish abandoned baby. And the reason it's called a bullish abandoned baby is the day before we gapped down. So whatever the news was overnight, or the sentiment overnight was bad, it gapped down. Well, the very next day we gap up. Not a lot, but a little. Well, this is what is called a bullish abandoned baby. We went from bearish sentiment to bullish sentiment. Now, when this happens, that's bullish. I could have just bought it here, actually, but I like to be a little bit more strategic and wait for AGQ to come down to the top of that abandoned baby. And that top of that abandoned baby is 34.58. So next week, if we go down and reject that 34.58, at that point, I will potentially get long this trade. And with abandoned baby trades, I make it pretty simple. I don't take partial profits on this particular strategy only. I place a 2 ATR stop and a 4 ATR profit target. So if I'm right, I make twice as much as if I'm wrong. But the nice thing about this strategy is in my experience, about 70% of the time, I make twice as much as I lose. So 70% of the time, I usually make 4 ATRs. 2%, 30% of the time, I lose 2 ATRs. So 70%, I make 4 ATR profits. 30% of the time, I lose 2 ATR profits. So yes, I could get in right here because the abandoned baby is valid, but I like to wait. When these abandoned babies happen, they usually happen. Come back and test the top before they take off. And just to kind of give you an example of other abandoned babies, this one here was a bearish abandoned baby. I took this trade, gapped up, gapped down, came back to came back to the bottom, and then I rode it all the way down. That was a monster trade. Here is what is called an island reversal. Island reversals and abandoned babies are similar. Abandoned babies just one bar, island reversals or two or more bars. Look at that. We gap up, sideways, gap down. Was it right? It certainly was. Will it be right this time? I don't know. But that is potentially what I'm waiting for in AGQ. It might just take off and go up and I'll miss the trade, but that's fine. But if it does come down to 34.58, ideally rejecting that, meaning it went under and kind of closed above it, that is where I would potentially get long AGQ next week at 34.58. So that's what I'm looking for next week on AGQ. Amazon. Okay, well, you see a red bar here. That will probably tell you that I'm looking for a short. This is an order block. Here on the 16th is our highest up bar close before market structure change. Therefore, if we come back up into the bearish order block and reject it, I could potentially get short. Well, that was the trade on the 26th. I did not take this trade, but it did reject. You see, we have the up bar, we break structure, we come into the bearish order block, and on the 24th, we got into the order block. On the 25th, we closed below it. I could have taken that short. I didn't take the short, but you can see the next day, boom. But the big picture here is showing you that we have this bearish order block. We break structure, we come back up to it. But interesting how just right when it got to that level, it falls back down. Okay, so I didn't get short here, but what I'd be looking for is another move back up, maybe a little higher into the order block, someplace between 233 and basically 228. I don't want to short here. I want it to rally back up a little bit more, but mainly just to give me a better risk to reward ratio. So that's what I'm looking for on Amazon, AMZN. ARK, again, it's going to be similar. Here is your order block on ARKK. The high and the low of the order block on the 16th was 63.14, low 61.48. Same thing, the 18th broke the structure to the downside, also broke the trend line. This puts us into a bearish market structure. I'm just waiting for ARKK to either reject the bottom of the order block here or the top of the order block here. I don't know if it's going to do it, but if it does, that's where I'll potentially get short. But I'm looking for a rejection of either the low of 61.48 or the high of 63.14. These are the highs and the lows of that order block. But I don't know if that one's going to get there. Not sure. Alibaba. Okay. Well, Alibaba, we were speaking about bullish order blocks, or I'm sorry, bullish abandoned babies. Here's one. We gap down, we gap up. Was there a nice tradable area in there? Yeah, there sure was. This one right here on the 10th was also a bullish abandoned baby. We gap down, we gap up. But what I'm looking for at this point right now is simply the 200-day moving average. This is the black line. This is the 200. This is a key important level. I didn't buy it when it went under over here because the risk to reward ratio wasn't so great. So I'm just looking for some kind of rejection next week of the 200-day moving average, the black line, either a bounce at the 200, an intraday rejection of the 200, or a close under, close over. And the nice thing that I like about this is, if you go back to AGQ, the high of the abandoned baby here is about $83. So if we come back down on Alibaba and test that 200, not only will we be testing the 200, we'll also be testing the high of that abandoned baby there as well. So I'm looking for a rejection essentially next week of the 200-day moving average. Caterpillar, very similar. This is a deep dip buy. I'm just simply looking for the 200, a bounce at the 200-day moving average, just like it did back on the 20th. You can see it bounced there. I didn't buy it. I didn't like the risk to reward ratio, but if we come down next week, bounce again, intraday rejection, close under, close over the 200-day moving average, that would be an interesting point, because the nice thing with the deep dip buys, the nice thing with the 200s, the 250, the 330 RSI, they're very well defined risk to reward ratios. And by the way, if you'd like to learn more about deep dip buys, I have a really good course available at udemy.com. The link's in the description. It's very affordable, very thorough, and I take you, it's 9.5 hours of video, and I take you through every step on how to trade the deep dip buy. I think it's somewhere between $30 and $50 on udemy.com. I don't control the price, they do. But I have sold so many around the world. There's like a 4.85 or 4.9 out of 5 stars on that course. So that's a really good way to get started. Again, the link's in the description. But here on Caterpillar, just looking at the 200-day, and the other nice thing on Caterpillar that I like, we have a nice confluence. We have a 200-day moving average, the black line, and we have the negative third ATR channel here. So that's a nice confluence. That's why I drew the green box right here. Doesn't mean it's going to work, but buyers usually come in at the 200, and if enough buyers come in, maybe we'll continue to go up. But the good thing about deep dip buy is that if it bounces at the 200, you're bullish if it stays above the 200, you're bearish if it closes below the 200. Makes it very easy. Okay, here we go, Microsoft. So I talked about Microsoft last week, and I said, look, if it gets down to this 200-day moving average, I mean, anytime you can buy Microsoft with a 200-day moving average, it's probably a pretty good spot. I mean, look right here on the 29th. Look at this nice little intraday rejection with a good risk to reward on Microsoft. Worked out great. I didn't take that trade, but it would have worked out great. But what I like about Microsoft even better on this 200-day moving average is that the gray line is the 50-day moving average crossed over the 200-day moving average. That is called a golden cross. And of all the years I've been trading over 29 years, what I have noticed is when you have a golden cross, even though long-term that's bullish, usually immediately get a pullback, which is exactly what happened. But what I also noticed is that first pullback to the 200-day moving average after the golden cross usually tends to be a really good bounce point with a good risk to reward ratio. So again, with the confluence on this particular trade is one, just the 200-day moving average by itself, but two, we recently had the golden cross. So after you have the golden cross, the first move back to the 200-day tends to be a high probability trade. So it's not there yet. It may not get there. It may just take off from here and I'll miss it. But that's okay. Something that I'm looking at will get to what I like. But this is what I'm saying. Looking on the weekends, looking at a chart and going, oh boy, if right now I could wave a magic wand and we have this golden cross and we have a rejection of the 200-day moving average, it's a high probability trade. Doesn't mean it's going to have to be a profitable trade, but it's a high probability trade. So what I'm looking for next week on Microsoft is a intraday rejection of the 200-day moving average, deep dip buy, or a bounce, or even a close under and close over. So that's Microsoft. Netflix. Okay, red bar here, that means order block. Here is your high, back here on the 11th is your highest up bar close before market structure change. The 18th changed structure on everything for the whole market. SPYs, Qs, everything. So if you change market structure to the downside, the move is to short rallies after the market structure change, like these. I didn't short this. I could have, but I didn't. And you can see we change market structure. We go right back into the bearish order block, and that's where it failed. So what to do with Netflix? Well, if we rally back up, and really what I'm looking for is a little bit higher of a retracement up, but I could have shorted here because this was the first rejection at the bottom of this order block, the low of 923.08. But it's not that great of a risk to reward. So really what I'm looking for next week is rally back up, give at a shorting at a higher level with the rejection of the order block, or even ideally getting higher into the order block or rejecting the high of the order block, rejecting the high of 941.75 intraday and then closing below. That would give me the highest short price and the greatest risk to reward ratio. Philip Morris, PM. Okay, so a lot of these defensive consumer stocks have really got trounced over the last month. I mean, look at this, straight on down, straight up, straight on down. But this is a nice looking potential long trade here. And you can see my green box here. This is what will show you this is my buyable area. But why is this the buyable area? It's your lowest close back here on the 22nd of, or the 21st of October, lowest close bar before market structure change. If you go from a bearish market structure to a bullish market structure, remember this order block area, this green box area, that's the place that I want to buy. So I'm looking, so the high and the low of the order block here is 119.12, the low is 117.22. Ideally, what I want to see next week is it come down, test the high of the order block, and then bounce above it, close back above it. That would potentially get me long. Or alternatively, if we go deep into the order block, I want to see it reject the low of the order block at 117.22. So big picture, somewhere in this green box between 119.12 and 117.22. But this area here in the future, that is the smart money place to potentially get long PM. Not up here. Everybody had to just buy it up here. I'm not sure why, but now that nobody wants it, this is the area that I'm looking for. So this to me looks like a really good trade, but I just need it to go a little bit lower, test at least the high of that order block at 119.12, or ideally test the low at 117.22. But big picture, somewhere in this green area of 119 to 117. Shopify. Okay, well, red bar, that is a bearish order block. Yeah, bearish order block. Highest up bar close before market structure change. When you change from an uptrend to a downtrend, I want to short the rallies. And to short the rally, the first place to short this one would be at the low of this order block at 114.95. That would be a really good place. What I like about that level, 114.95, it's about halfway of the 18th. Big high. We have the high, the low, halfway into this. If we retrace halfway back up into this down bar, just that by itself, there's going to be some inherent resistance, but that also dovetails with the bottom of the order block as well. So just on Shopify, first place I would look to short would be a rejection of 114.95. It's 108.18, so not sure if it's going to get there, but if it does, that would be a really good short. SLV is silver. Very similar to the AGQ, because AGQ is just double leverage silver. But look, here we have a bullish abandoned baby, gap down, gap up, coming back down to the high of that bullish baby, abandoned baby there at 26.65. So if we bounce at 26.65, that would be the same as the AGQ trade that I showed you, just different numbers. But that's coming into that, to me, that's coming into a viable area. And then last but not least is XLE. XLE is real estate. You can see the real estate has gone down significantly with the rise in interest rates. But the 300-day moving average to me looks interesting here. 300-day moving average is at 39.84. We're at 40.54. That would be a deep dip buy, a very deep dip buy at the 300-day moving average. But I would need the price to come down, bounce at the 300-day moving average, intraday reject it, or even close under, close over. And it certainly may get there. So that's what I'm looking for on the daily. Let's take a look at some of the weekly charts, weekly bars. Weekly charts close on Friday. I would make my decision on Friday. And so here is AMD. Well, that 200-day moving average, that really is a nice place. I've talked about AMD for weeks, even when it was up here, and I said, hey, if it gets down to the 200, that would be the spot. Don't know if it's going to get there, but it may get there. Right now, we are at 125.24. That's at 114.28. So, it's still, $9-10 away from that. But look what happened last time it was at the 200-day moving average. Was that the place to buy? This is all the way back in 2023. Yeah, that was the place. It respected the 200 and went on a huge up move. Well, we're getting close to the 200 again. So next week on Friday, if it bounces the 200-day moving average or intra-week rejects it, I would consider getting long AMD. GDX gold miners, very similar to AMD, but this is a deep dip buy again, 200-day moving average, but there are a lot of confluences on GDX. One, we have the 200-week moving average. Two, that 200-day moving average or 200-week moving average dovetails with the negative third ATR channel. That's a nice confluence by itself. But bonus on top of that, look, here's your golden cross. Here's your 50 crossing your 200. Just like I mentioned on Philip Morris, when you have a 50 crossing the 200, the first pullback to the 200 usually is a high probability trade. So we're at 34.26. That's at 32.14. So it's still a couple bucks, a little more than $2 below. I'm just going to be patient and wait. But me personally, I definitely am going to take this trade if next week by Friday or the week after that or the week after that rejects the 200-day moving average, because one, is the 200-day moving average, two, it's at the negative third ATR channel, and three, we have the golden cross. And when you have the golden cross, the first pullback to the 200 after the golden cross happened usually tends to bounce. Usually, not all the time. 20-year treasuries, TLT, wow. TLT, the bonds have just gone straight down. As you know, if bond prices go down, interest rates go up. So interest rates are really, really high right now. But I think we are getting to a spot on TLT where there's a really good opportunity. And on the weekly here, we're going all the way back to the order block here of 1020. This is the lowest bar close before market structure change. After the market structure changes, if we ever get back down to the green box, if you ever get back down to the order block, that is usually a buyable area. Here you can see on the April of 24, we got kind of close before we had the big run up. Well, we are getting even closer now. So what I'm looking for on TLT is I am looking for a rejection of either three areas. One would be the high of the order block here, 86.66. That's about 45 cents below where we are now. So next week, if we came down, tested under 86.66 and closed back above, that would be a potential long entry for me. Second would be 85.70, a rejection at 85.70. Why that number? Well, look at the big up bar we had back here on the November 3rd, 23. Big up bar. If you have a big up bar and you come back to halfway of that bar, that is some inherent support there as well. I like that spot a lot. 80, 85.70. So that's, we're 87.09, 85.70. I feel pretty confident that you're going to have some kind of bounce there. I mean, I could be wrong, but I just wanted to show you the three levels that I'm looking at. So the high, 85.70. If we reject 85.70, that would potentially get me long TLT. If we go lower, reject 80, I'm sorry. 86.54. 86.54 is the high of the order block, or a rejection 85.70, which is halfway that big bar that we just discussed, or a low of the order block, which would be 82.96. Boy, if it goes to 82.96, market's going to go down. I'm certain of that in a big way. So hopefully we don't get that low. About a rejection of 86.60 or a rejection of 85.70. Those are the two areas that I'm looking for. But I am looking to get long TLT because this is a hugely strong move down, and we are getting into that sweet spot of the order block. And then last but not least, XLV. XLV, this one's pretty easy. It's just the 200-day moving or 200-week moving average. Right now we're at 138.97, 134.54. Obviously, healthcare has just gotten wrecked. I mean, look at this. Back in August or whatever, 159. Now we're at 138.97. Don't know if we're going to get there, but if we do, I would certainly consider that. So anyway, I hope it was helpful to kind of take a look at these potential trades next week. If you have any questions, please put them in the comment section. Be happy to help you. If you're interested in private one-on-one lessons, I teach a great 15-hour course. As I mentioned earlier, all you have to do, my email's in the link of the description. Just send me an email. I like to have potential. It's a free Skype call with any new potential students, just to get to know them a little bit, learn more about them and their trading and their trading challenges and their trading goals. It's a good time for the student to ask me any questions about the course. It's not a sales call, just a get to know you call, and when we're done with the call, that's it. And if you want to take the lessons, you just have to email me back and say, Greg, I liked what we said on our call, and let's schedule. But you're going to learn a lot. I love to teach. It's a good time of the year, coming into the new year, to learn new skills. So love to hear from you, and I love to teach you everything I know. Again, if you like the online courses, you can take the Udemy course. The link's in the description. I know you'll like that as well. But I hope you have a good rest of your weekend, everyone. I'm still here in Colombia. Really beautiful place. Enjoying my time a lot. And I always like to leave off with, please try to go out and do something nice for somebody today. Just one simple, nice thing could make a difference in someone's day. And if you could also do something nice for an animal, I would really appreciate that. But thanks for your time today. If you enjoyed it, I appreciate if you could hit the thumbs up button. Helps out the channel a lot. If you could subscribe, that also helps the channel. But again, thanks for your time. Hopefully it was helpful. And God willing, we'll talk to you next week. Thanks, everyone. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. There is a potential for large rewards. There is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation, and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.